Most investors see a high yield and assume higher income means a better investment. But I can tell you from personally stress testing 75 high yield income ETFs, the reality was very different. Some funds generated strong income while holding up surprisingly well. Others were delivering strong income, but destroying your capital value underneath the surface. So in this video, we're breaking down 5 new high-yield income ETFs to bring our total to 75. We'll see how the new ones did, we'll see how all 75 come together, and of course, we'll check out our updated leaderboard. Hey guys, welcome back to the channel. It's time for another update on our massive high-yield income ETF stress test. And there's really no point to doing this big, long intro, so let's dive into the analysis. We'll do an all-up review, we'll look at the charts, and we'll look at that leaderboard. And of course, I'll give you a sneak peek of the 5 additional high-yield income ETFs we're going to check out in the next analysis. This spreadsheet keeps getting longer and longer. This is right here where it's going all the way down here. Here's the bottom right down here. Well, keep going, still going, there we go. So what we're going to do here, we'll just sort it first off by ETF provider. You can see here we've got an ever-growing list of different ETF providers and different types of income ETFs, whether it's based on broad market indexes like the S&P 500, whether it's based on materials such as gold or silver. We got foreign indexes in here and everything in between. We got funds here from Amplify, BlackRock, Cornerstone, Colin, Defiance, Eaton Vance, First Trust, Global X, Goldman Sachs, Invesco iShares, JP Morgan, Maine, Neos, Overlay, Pacer, ProShares, Rex, Roundhill, Simplify, SRH, Tap Alpha, Westwood, and of course, maybe the most infamous, YieldMax. Here's the funds we're talking about today. We've got from BlackRock a closed-end fund, BTX. We've also got DIV from Global X, which is similar to SDIV, but it's actually just in the United States. We've also got, scrolling down here, RSPA. That's a really cool one. That's based on the S&P 500 equal weighted index, but also adding option income. We've also got BNDI down here from Neos, which is a bond ETF. And we've got Gcow from Pacer ETF. So 5 new funds. Let's dive in. We'll work through those one at a time, and then we'll look at that all-up review. All right, first one we're talking about here is BlackRock's Innovation and Growth Term Trust, BTX. It's actually a closed-end fund. I'm not sure why they're coding it as a mutual fund. It's my understanding, at least. If you can recall, closed-end funds are unique because they trade like a stock, where they could trade at a premium or a discount, as opposed to always reflecting the underlying value of the assets. Sports a pretty good yield at 9.35% right here. So let's dive into the analysis. All right, so here we got BTX here. It was launched in March of 2021, and we can see here that, well, the results are just not good. In fact, they're horrendous. This is a fund that I remember, it's got a good yield, but the problem is I remember talking about it when it first came out in 2021, and it just got pummeled in 2021 and 2022 from a net asset value perspective, dropping from 20 to 14, and then from 14 down to 6. That's just atrocious. And you can see overall we've lost a ton of value, and the total return is just horrendous when you factor in just the distributions, which are not actually that amazing. Distribution coverage here is negative 1.94. So there's just really nothing to like about BTX. You can see here how much right here. This is interesting, right? This is the net asset value. Obviously, the first 2 years were the most impactful. But from here, this is what it would look like here. Just the net asset value compared to how much we would need to reinvest in order to maintain that initial 10,000. That number is like insane. It's like 200%, I think. What is it? 229%. Not a good fund. Although again, significantly impacted mostly by the first 2 years. You can see the distributions here have been kind of hit and miss here, down a little bit, popped up, coming back down again as the actual dollar amounts. In 2025, we scroll down here, what happened in 2025? You still would have had to reinvest 105% of dividends in order to maintain your 10,000 balance just in that 1 year. And as a result, there's no usable income in 2025. And if we look at the Sharpe ratio or the risk-adjusted returns, we're at negative 0.556. So that's not good. And in 2025, I'm guessing that was -2. Scroll down to the bottom, check it out. Yep, negative 0.12. So I wish I could sugarcoat some of this and say, hey, you know, BTX is pretty bad except for this or except for that, but it's just not good. All right, next up, we're talking about Global X's Super Dividend US ETF, ticker symbol DIV. This one's unique. It's similar to SDIV, but DIV is just for the United States. It's an ETF that mostly invests in high dividend yield equity. The fund tracks an equally weighted index of 50 high dividend, low volatility securities. It's been launched back in March of 2013. Now, we've got data going back to 2016 or past 10 years. So let's take a look at that. All right, so this is interesting. Overall, since origination, and by that I mean since 2016, the last 10 years, we have a distribution coverage ratio that's positive, but it is below 1. So that's not a good sign. That does tell us, it's one of the first indicators to us that there is in fact net asset value erosion occurring. You can see some years were good, like 2016 and 17. 2018 was bad. 2020 was bad, really, really bad actually. 2022 was bad. 23 was bad. And some of these years, like 2025 even, were below 1. So that's what's really contributing to that number. You can see here that there was net asset value erosion because the orange line and the blue line are not the same. Remember that if the orange line is overlaying on top of the blue in this analysis, it means that no net asset value erosion is occurring. However, we can clearly see that there is net asset value erosion, which means that we are going to have to reinvest some of those dividends or distributions along the way to maintain the net asset value original balance. That amount is 29%. 29% of assets would need to be reinvested along the way. It's not terrible, but not good. I prefer 0 or a really low number. Here's a look at the distributions right here in red. You can see they fluctuated a little bit. Oops, a little bit too far. Fluctuated a little bit, but ultimately averaging right around 12 cents per share. Here's that amount here, which is a rolling 3-month average, which kind of smooths it out a little bit. If we scroll over to the right, we can see our 2025 information. Scroll down here. What would have happened if we'd invested $10,000 at the beginning of 2025? And at the end of the year, we would have to have reinvested 68% of assets or distributions in order to maintain that $10,000 balance, which leaves us only with $224.61. So 2025 wasn't a good year, but then overall as well, not a good track record of paying out a reasonable number of dividends and not too many. If we look up top here for the risk-adjusted returns for the Sharpe ratio, we're at 0.107 since origination, which is not horrendous, but it's not good either. If we look at just 2025, it's negative 0.25. So DIV here, again, not a fund that has a really good track record, and nothing really I can point to that says, hey, this is actually a pretty good fund in some way, shape, or form. All right, next up, we're talking about the Invesco S&P 500 Equal Weighted Income Advantage ETF, ticker symbol RSPA. Now, this one I actually hadn't heard of. That was actually kind of cool because I've looked at RSP before from Invesco, which is the S&P 500 Equal Weighted Index, which is the idea that instead of market cap weighting funds, meaning, NVIDIA is at 7% and, Microsoft is at 5% or whatever. Instead here, what we do is regardless of how big the company is, we equally weight the fund so that all 500 stocks in theory have an equal weighting in the fund, which probably reduces volatility and definitely reduces concentration and increases diversification. Obviously with the Majestic 7, the 7, the strong ETFs, right? Those really have been performing really well, which means that the regular S&P 500 has outperformed the equal weighted one. But it's an interesting idea. So this one here, like it says here, it's actively managed fund of funds that utilizes equity securities and ETFs to mirror the S&P 500 Equal Weighted Index, and it also utilizes equity-linked notes or ELNs for upside participation and downside protection. Very interesting. Fund has only been available since July of 2024, so we don't have a ton of data here, but we do see we like, right? It has a distribution coverage ratio above 1, which means no net asset value erosion, even in the short time we have it available to us. We scroll down here, you can see that this is the S&P 500 rapidly or significantly outperforming the total returns of this fund, which makes sense. You're generally going to see that, especially with the broad market ETFs, especially over the past few years. We don't have any net asset value erosion because this is that orange line, which is overlaying the blue line perfectly. Here's a look at distributions, which I do like that they are consistent, right? They're not all over the place and volatile. Here's that smoothed out 3-month average of those distribution payments. And like I said here, we're going to go up to the right. We can see that the hybrid reinvestment percentage is 0, meaning that no net asset value erosion is occurring and no additional distributions must be reinvested to maintain $10,000 in value since origination. And if we scroll over here to the right, we can see here 2025 data. If we started in 2025, ended in 2025, we would have had, let's see here, no net asset value erosion, and we would have had available income of $929.77, which is respectable. We look at risk-adjusted returns here, top right, Sharpe ratio, 0.546, which is really good actually. And if we scroll down to the bottom, we can see that 2025 Sharpe ratio was 0.38. So this is an interesting idea as a way to diversify a high-yield income ETF fund. I think it still remains to be seen if it's a better idea than like SPYI or some of the other S&P 500 funds. We will have to eventually do an S&P 500 review of all the funds in there that are S&P 500 related, or at a bare minimum, looking at like the broad market index ETFs. All right, next up we have the NEOS Enhanced Income Aggregate Bond ETF, ticker symbol BNDI. And scroll down here, you can see here that this is a fund that invests in investment-grade fixed income, and it's a diversified portfolio of fixed income securities with varying maturities and credit ratings while utilizing a U.S. large cap put spread strategy. Interesting. So we're owning bonds and then we're utilizing a broad market. My guess is going to be S&P 500 here. If we go to the holdings, we can double check that. It's got to be the S&P 500. Almost always is. Yep, there it is right here. S&P 500 put options, which is a very interesting idea that they're doing put options and a spread strategy as opposed to just selling put options. Very interesting. And so we've had BNDI since August of 2022. It has a distribution coverage ratio below 1. That's not good. It means we do have net asset value erosion. And it was okay in 23. Okay in 25, but 24 was not good, and 2022 was not good either. What's interesting, though, is it is absolutely outperforming BND, or the total bond market fund from Vanguard. And this is the total returns with reinvested dividends and just total returns overall. We do have net asset value erosion occurring here because we see both the orange line and the blue line. And we'll go over to that number in a second here. But distribution is very consistent. I like that across this time frame for nearly 4 years. And here's that rolling 3-month average. Let's look at that. How much would need to be reinvested since origination? 20% of distributions, which is not a horrendous number, but not a good number either. If we look over at the 2025 data, right here, we'll scroll all the way down here. In 2025, we'd started with 10,000. We would have ended with 10,311, which means we had no net asset value erosion, at least occurring in 2025. We had $580.70 available to us in 2025 as a result. If we look at the risk-adjusted returns, scrolling up over here, negative 0.044. Not a huge fan of that, which means that it's just too volatile given the actual returns that we're receiving. Scroll down here, in 2025 it was not bad, 0.53, which is actually really respectable. Interesting idea, and it's certainly performed better than TLTW. That was a horrendous fund. We'll see that in the all-up analysis, but not one I would necessarily hold in my portfolio unless you were wanting bonds, but you wanted better returns than bonds. You'd probably maybe go with this maybe. All right, last one we're talking about today of the new ones is the Pacer Global Cash Cows Dividend ETF, Gcow, or Gcow, I guess. And so this is an interesting one. It's an ETF that is tracking an index of developed market large cap stocks selected by free cash flow and dividend yield, weighted by aggregate dividends. So this fund has been in existence since February of 2016. So we've got over 10 years of data now, which is going to be great to look at. Some of the top funds in this ETF are, let's see here, ExxonMobil, XOM, we can see, Chevron, CVX, Altria Group, ConocoPhillips, Shell, we've got CNQ, Philip Morris, Verizon, Merck, Bristol Myers Squibb, etc. But no one company owns a significant portion or has a significant weighting in this index. All right, so Gcow's got really good data. Since 2016, obviously in 2018, 2020, we had some issues there, which was coinciding with volatility issues and or just a general recession. But overall, every single year except for right here, and the two negative years, of course, every other year except for 2024 and these 2 years, we had really, really good levels of distribution coverage ratio, which means overall we're at 2.59, which is excellent, almost too high. And here's a look at the analysis over time. This is just what $10,000 would have done if it was total returns with reinvested dividends, which was great, just total returns. And then right here, we see orange on top of blue, which means no net asset value erosion. Here's a look at distributions. They're a little bit too volatile for me. I don't love that necessarily. They pay out distributions quarterly, which I'm not as big of a fan for when it comes to retirement income. I would prefer to get monthly, but it overall has really good net asset value protection. And we'll talk about that in a second. Here's that rolling 3-month average, which essentially doesn't do anything for us because it's quarterly already. If we look at the net asset value erosion, we would have to be 0, right? That's great. No additional distributions would need to be reinvested to maintain 10,000. And here's 2025 data right here. Started with 10,000, and if we'd not reinvested at all, we would have had usable income of $304.44 with no net asset value erosion occurring. And if we go back to the top here and look at risk-adjusted returns through the Sharpe ratio, right, 0.447 since origination. And if we look at in 2025 alone, we're at 1.34, which is actually really good. So this is a unique way of doing things. It doesn't have a great yield. We didn't mention that here. The average yield here is 4.24% since origination. So I kind of want that yield to be more like 5 to 8% maybe at a minimum if it's going to be more balanced. But ultimately, it performed really well from some of those metrics from a stress testing perspective. All right, here's our all-up analysis. You can see, obviously, funds that have red in this section here are generally not good, like BTX with 229% required. This is just a horrendous fund. But QQQY, IWMY, funds here with the really high numbers for reinvestment required, those correlate very well with net asset value erosion occurring. So these funds right here, BTX, YBIT, ULTI, BTCI, SEPI, TLTW, etc. Ones you really want to avoid. You also want to see it right here, the net asset value change only since origination. Also some strong correlations there. If we look at Sharpe ratio, or sorry, distribution coverage ratio, we look at the highest numbers here versus the lowest number. You can see the correlation here with the yields. I'll talk about that in just a second. But if we look at the distribution coverage ratio here, these are funds that you generally are going to want to invest in because they have a consistent record of not paying out too much in dividends compared to their actual underlying performance. You've got positive net asset value changes here. And what you'll notice again, if you sort this by yield, this is the perfect picture as to why yield, it's loading right now, why yield is not the only thing you can look at, because you might have really strong yield but terrible total returns like ULTI, YBIT, YBTC, YMAX, GDXY, really high levels of yield, but also really terrible distribution coverage ratios. The only outlier maybe is GDXY right here, which has been on a gold, like just run significantly. But the majority of these ones in here, they don't have high yields, and they do have high yields, but they have really bad distribution cover ratios. A lot of that income would need to be reinvested along the way. Like I said, we've also got like total returns here, total returns over the past 3 years. So if we're looking at like total returns over the past 3 years, the top funds here, I don't think we saw a major change here. We still have like, I think the top 3 or 4 here. We sort this. Yeah, we've got right here. These are our top 5. No major change there. Gcow does crack the list here for top 5 here from a 3-year total return perspective. And we can sort this, of course, by 2025 performance, which is more of our apples to apples comparison, because we do have a significant of funds where we, almost all of them have at least 2025. And we can see the top results here. Gcow almost made the list. It was number 6 here, but GDXY, SOXY, IDVO, OVF, and then TDVI here all made the list. Again, there's still good quality funds in here like QQQI and SPYI that just don't make the top 5 on certain metrics, but they're overall really balanced funds. And speaking of balance and like scorecard metrics, let's take a look at the scorecard right here. We did have a few break in here. Gcow right here, NAV change right here, positive 89%. Gcow made the list here. It also made it here for total returns, which is really good. Also made it over here for Sharpe ratio and over here for distribution coverage ratio. There's like GPIX, GPIQ as well. Just because you don't see a fund in the top 5 or 10 here in the high-yield income ETF leaderboard doesn't mean it's a bad fund. You gotta go back to the main all-up review and check and look at specific funds and how they tested. Here's a look at the charts here. We've got March 24 through February of 2026. We've got like BNDI and Gcow. Nothing major changed here, in my opinion. We've got in orange, we've got CLM, and then we've also got IDVO up here. So no major changes from funds we were talking about today. Was this one up here? YBTC. And if you look at the net asset value only right here, no major changes here. Like BNDI and Gcow, we're kind of in the middle of the pack on these funds for 2024 to 2026. So no major changes there. If we're looking at August 2022 through February of 2026, we did have, let's see here up top, we had OVL is up top here. We've also got QYLG. Oh, right here. This is Gcow right here in the pink. This one that shot up really quick right here. So that one made an entrance. No major changes there, though, on this frontier. We still got the highest one up here is OVL, but this is Gcow in second place over this nearly four-year time frame. And then here is September 2020 through February of 2026. We've got Gcow up here in the #1 position in total returns, which is great right there. And then the top result up here is OVL. Most of those funds are kind of right in between here. We're looking at like DIV and EVT are right in the middle there. And this is just the net asset value only. Gcow is like really challenging. What was OVL here for the top spot, whereas most of them like down here, like this light blue, that's CLM. And then what was that other fund in here? Oh, right here, this orange is EVT. And then DIV is right here in the middle. I'll admit, there's a ton of data here you got to look at. So if you want to get access to this spreadsheet and all the future iterations and previous iterations of this spreadsheet, check out the Average Joe Investor Income Academy on the School platform. There's a link down in the description below. You can get in with an annual subscription for like half off if you want to check that out. And we're looking at even ways to explore hosting this on a website so it's a little bit more easy to be accessed. But again, if you're interested, checking out the link down in the description below. Hopefully you found some value out of this video, guys. Make sure to leave your 2 cents down in the comments below. I want to hear your feedback. I know that there's other ETFs you guys want to see. I've got a list here of like 20 additional ETFs we're going to cover. So we've got plenty in reserve here that we're going to continue moving on to and analyzing. I know that we want to get the Sortino ratio in there as well as to complement that Sharpe ratio to make sure we're getting that upside volatility and downside volatility separated out. But again, if you've got feedback for me, check out the, make sure to leave your 2 cents down in the comments below. That's all I got for you guys. Have a great rest of your day, and thanks for watching.